Nebius just missed earnings by 8%, dropped nearly 4% in pre-market, but it actually bounced back on one of the worst trading days of the year. Why? Because again and again, what's buried inside this report tells a completely different story than what the headline suggests. Look, if you're short on time and you refuse to listen to some random cat on the internet, here's the single most important thing you need to know. Nebius is not a revenue story right now, it's a capacity deployment story, and until you understand that distinction, you will misread every single earnings print this company puts out. That's it. That's the thesis. Now, if you want the full breakdown, the good, the bad, the genuinely concerning, stick around. Hey, for those who are new here, I'm DataCat, a former corporate analyst, spent some years inside a Fortune 50 company staring at trash data until I decided, you know what, I'd rather talk to a camera and make cat puns for a living. Now, apparently not a very smart choice. I may be delusional, and the channel's already been around for about 7 months now, but I'm not going to pretend I know everything or say I've cracked the secret code to financial freedom. I'm just a guy who reads filings, looks at the data, and tries to make sense of it. Kind of like a cat knocking things off a table. Except the things are financial narratives and the table is Wall Street consensus. If any of that sounds useful to you, a like and subscribe genuinely helps. No courses, no paid groups, no join my Discord for more. Just data analysis and the occasional cat joke. That's the deal. Alright, let's get into it. So, Nebius reported fourth quarter group revenue of $227.7 million against a forecast of $247.5 million. That's roughly an 8% miss. And look, on the surface that's not great. The stock dropped over 3% in pre-market, and if you saw that number flash across your screen before market open, your gut reaction was probably, uh-oh. But then something weird happened. The stock recovered. It climbed back to $89.73 after the open. And this happened on a day, and I need you to understand the context here. This happened on a day where the S&P was down, the Nasdaq was down, the Dow was down, gold was down, silver was down, Bitcoin was down. Basically everything with a ticker symbol was having a terrible day. I didn't exactly count, but social media is shouting that the market has evaporated 3 trillion yesterday. And Nebius bounced. Now, to put the stock's journey in perspective, the 52-week range on this thing goes from a low of $18.31 to a high of $141.10. So even at $89, we're sitting roughly in the middle of a very wide range. This is a volatile name. But the intraday reversal on a broad risk-off day, that's a signal worth understanding. So what did the market see that the pre-market panic missed? Let me walk you through what was actually strong in this report. Number one, the cleanest one. It continues to show demand is exceeding supply. And I don't mean that in the hand-wavy way companies sometimes say it. Nebius is claiming they were sold out in the third quarter, sold out in the fourth quarter, and sold out into the first quarter of 2026. On top of that, new cloud customer contracts are running about 50% longer in duration. And here's the part that matters. Their average selling price reportedly increased 50% quarter over quarter, with pricing nudging up even on renewals and older GPU generations. Now think about what that actually means. If you're sold out and your prices are going up and your contract durations are getting longer, that's not just demand, that's pricing power. That's customers saying, I will pay more and commit for longer just to secure capacity. In a commodity-ish business like GPU hosting, that kind of dynamic is, well, it's like a cat that actually comes when you call it. Rare and valuable. Number two, prepayments are transforming their near-term cash position. They reported $834 million in operating cash flow in the fourth quarter, primarily from upfront payments on long-term agreements, and they're sitting on $3.7 billion in cash. Now, I need to be honest with you, and we'll come back to the caveats on this. Operating cash flow driven by prepayments is not the same as operating cash flow driven by recurring normalized business operations. But in a capital expenditure-heavy business where you need to build data centers before you can recognize revenue, having customers effectively help finance your build-out, that is a genuine structural advantage. It's not nothing. Then, number three, and this one's about credibility more than anything, execution on major contracts. Meta's deployment is fully live as of early February. Microsoft's first tranche was delivered in November, with the rest rolling through 2026, majority in the second half. In the data center business, on-time delivery is how you build trust. Missing build schedules is how these stories fall apart. So far, they're delivering. And number four, they're building a platform narrative. Token Factory, their Ether releases, the Tavali acquisition for agentic search and developer tooling. They're trying to move from selling what is essentially commodity GPU hours to building something with higher switching costs, differentiated software, and vertical solutions. This is almost certainly a defensive play against eventual GPU price compression and hyperscaler competition. They see the same future everyone else does. Eventually, raw compute gets cheaper. The question is whether you've built something sticky on top of it by then. Okay, I know I'm speaking as if the stock price is sailing beyond $100, while it's not. Now let me be the cat that knocks your optimism off the counter, because there are some obvious problems here. Risk number 1. The revenue miss is not trivial. Management essentially admits that revenue is constrained by deployment timing and physical capacity. They can sign contracts, they can announce run rate targets, but recognized revenue only shows up when hardware is physically delivered, installed, and utilized. If consensus expected more fourth quarter revenue, that's the market being reminded. This is still a construction story, not a software scaling curve. Bricks and mortar and power cables, not just code. Risk number 2, and this is the big one. The capital expenditure plan is enormous. They're guiding $16 to $20 billion in CapEx for 2026 against a revenue guide of only $3 to $3.4 billion. Let me say that again. 16 to 20 billion in spending, 3 to 3.4 billion in revenue. Now the unit economics might be great, the demand might be there, but it all comes down to the same question all over again. Do they earn an adequate return on this vintage of spend? And here's what's missing from the call. They don't give enough hard data on GPU payback periods, dollar per megawatt economics, contracted margins broken down by customer class, or utilization assumptions beyond 2026. The Chief Operating Officer actually jumped in specifically to address CapEx and financing questions during the Q&A. In my experience, when the COO steps in to handle that topic, it's usually because investors are pressing hard on one uncomfortable question. Are you overbuilding into a cycle peak? Risk number 3, the funding gap, and this matters to every investor. They say roughly 60% of 2026 CapEx is covered by cash, operations, and existing commitments. That means 40%, potentially $6 to $8 billion, still needs financing. And throughout the call, they keep highlighting financing tools they haven't used yet. Corporate debt, haven't tapped it. Asset-backed financing, available but unused. A revolver facility avoided by choice. An at-the-market equity program not used to date. Now I want you to listen carefully to that language. Not used to date, avoided by choice. That's not reassurance. That is rhetorical groundwork. They are preparing investors psychologically for leverage and potentially dilution down the road. The ATM mention is them saying, don't worry, we're not using it, while simultaneously telling you, but we can. It's like a cat sitting next to a glass on the edge of a table. They haven't pushed it yet, but the paw is simply just right there. Risk number 4. The profitability picture is more complicated than it looks. They're guiding around 40% adjusted EBITDA margin for 2026, which sounds fantastic. But they also explicitly say EBIT remains a loss. Why? Depreciation and R&D costs. In GPU and data center models, EBITDA can look excellent while true economic profitability is still unclear because depreciation is massive and CapEx is continuous. You're always buying the next generation of hardware. EBITDA flatters the picture. EBIT tells you the harder truth. And speaking of depreciation, risk number 5. They quietly extended their depreciation schedule from 4 years to 5 years starting in the first quarter of 2026. Now this might be justified, maybe the hardware genuinely lasts longer. But the subtle effect is this, it reduces depreciation expense per year, which raises GAAP earnings, at exactly the moment they want to show improving profitability while scaling. This is something Michael Burry has flagged about the broader AI infrastructure space, and we've discussed it on this channel before. I don't think it's wrong or a fraud, but it is an optics lever, and you should adjust for it when comparing periods. Don't let an accounting policy change masquerade as operational improvement. Alright, now let me share something I picked up from reading between the lines of the call, because this is where years of reading corporate transcripts actually pays off. First, they keep using the word visibility. They stress visibility into the second half of 2026 and into 2027 demand. When companies repeatedly emphasize visibility, it almost always means the market is worried about cyclicality and overcommitment. You don't need to reassure people about something they're not anxious about. Second, customer concentration. They insist the 2026 AR target doesn't depend on new mega deals. But then the call devotes enormous attention to Meta and Microsoft deployment schedules. That's a tell. Those two relationships are absolutely central to near-term scaling and narrative credibility, no matter how much management downplays dependence. Third, they highlight their stake in ClickHouse at a reported $15 billion valuation. Now, you don't bring up a portfolio company's valuation during an earnings call unless you want investors to underwrite something, potential monetization, collateral value, or downside protection for future funding. That's them showing you a card in their hand. Pay attention to when they decide to play it. And fourth, sold out is a double-edged sword. Being sold out sounds incredible, right? But it also means until CapEx lands, you cannot convert demand into revenue. The revenue miss against consensus is entirely consistent with that constraint. Demand isn't the problem. The ability to physically service that demand is. And so, let's come back to the central puzzle. Broad market carnage, an earnings miss, and the stock recovers. Here's how investors are likely reconciling it. Reason A, the miss was supply-gated, not demand-driven. Nebius is capacity-constrained. Many investors will treat ARR growth, pipeline strength, and rising pricing power as better demand signals than one quarter's recognized revenue versus a consensus number. In their framing, a revenue miss is timing. ARR strength is real. Reason B, on a day when the market is worried about liquidity, who can self-fund matters. A company sitting on $3.7 billion in cash, collecting massive customer prepayments, claiming 60% of CapEx is covered. That looks less immediately fragile than other high-growth names that depend on constant external capital raises. It doesn't eliminate the funding gap, but it improves relative perception when everyone's asking who needs money next. And reason C, AI infrastructure still trades like a strategic asset class. Some investors will pay for exposure to compute capacity bottlenecks even in a macro stress environment because they view it as scarce, contracted, and defensible. That creates pockets of relative strength even during broad sell-offs. Though, I need to be clear, the rebound does not make the core tension disappear. Their 2026 plan requires $16 to $20 billion in CapEx. If market narrative remains as repricing risk and tightening liquidity, the cost of debt goes up and equity issuance becomes more dilutive. Any slippage in build-out directly pushes out revenue and ARR. But if Nebius executes competently, not perfectly, just competently, here's what the most probable path looks like. First half of 2026 still largely capacity constrained. High utilization, strong pricing, revenue grows but not explosively because new sites only start ramping around the second quarter and the majority of new capacity lands in the second half. Second half of 2026, a meaningful step up. New capacity comes online, ARR accelerates sharply as they begin annualizing newly deployed tranches. They push to fill capacity with a mix of cloud customers and large strategic contracts. On the financing side, expect them to add some debt or asset-backed financing in 2026. They're explicitly preparing investors for that. And the ATM equity program, they say it's optional. But if the stock stays liquid and strong, a small opportunistic issuance wouldn't surprise me at all. 2027 becomes the pivotal year. That's when Microsoft is supposed to contribute at, quote, full annual run rate. More owned data center projects ramp up. If demand remains tight, this is when the model starts looking like a true scale platform. But if demand loosens, if the GPU scarcity narrative fades, that's when pricing and utilization become the real stress points. If you're following this name, whether you own it, you're considering it, or you're just trying to understand the AI infrastructure trade, here are the specific things to monitor over the coming quarters. 1. Actual financing terms. Do they raise debt? At what rate? What covenants? Do they go asset-backed? 2. CapEx actually spent versus what they guided. And critically, whether build schedules slip. Delays equal pushed-out revenue. Period. 3. Utilization and pricing once new capacity comes online. The question is simple. Do they still sell everything they build? 4. Deferred revenue and contract liabilities. How much of their cash flow quality is prepayment timing versus durable, repeatable profitability? And 5. Any indication at all, that they start tapping the ATM equity program despite saying they don't plan to. That would be a meaningful shift in the narrative. So that's Nebius, a company with genuinely strong demand signals, real execution on major contracts, and a pricing environment most businesses would kill for. Wrapped inside an enormous CapEx commitment, a funding gap that hasn't been fully addressed, and profitability metrics that need careful interpretation. It's not a simple bull or bear case. You're basically buying a bet on AI compute scarcity persisting long enough for this build-out to generate returns. And whether that bet pays off depends on timing, execution, and a financing environment that nobody, not management, not analysts, not even a very smart cat, can fully predict. That's all I've got. If this kind of breakdown is useful to you, hit that subscribe button. Like I said, no courses, no premium tiers, just a former corporate cat trying to make sense of markets one earnings call at a time. Alright, DataCat out, and I'll see you in the next one.